I started in the 1970s, and that's when the word stagflation was invented. But it was a combination of stagnation or low growth or recession and inflation. Now, going back to the 1960s, the theory was, well, you can have high inflation with high growth, or you can have low inflation with low growth. But nobody thought that you could have high inflation and low growth. That's what we got. And that's what stagflation is. And we could be headed in that direction. The inflation's already here. So that's people have debated that for a year, but that debate's over. The inflation's here. The question is, how are we on growth? The answer is not very good. The Federal Reserve Bank of Atlanta has a GDP forecasting tool, which is quite good. None of them are perfect, but it's the best one I've seen. As of now, they're projecting first quarter U.S. growth at 1.3%. And of course, the first quarter is over. It's over at March 31st. We'll get the number next week. But their forecast, which is pretty accurate, is 1.3%. That's almost a rounding error away from a recession. So it's weak to begin with. And that was mostly before the war in Ukraine, because the war didn't start till the end of February. The sanctions didn't come on until March. So 2/3 of the first quarter had nothing to do with the war. But now, of course, not only are we in the war, but the sanctions are starting to have a much bigger impact. So I would expect second quarter growth to be even weaker, maybe even negative in the United States. And yet I don't see any end to the inflation for the reason we just mentioned, which is the Fed can't raise interest rates enough. So we may, in fact, get this, what we call stagflation, which is weak growth and high inflation at the same time. And of course, the weak growth will be very bad for stocks. Right. Well, tech stocks have had a great run. We all know about it. And they were big beneficiaries of the pandemic because, at least in the United States, and I believe it was true in South Korea as well, people couldn't go out. I mean, the restaurants were closed, stores were closed. You could stay home and watch, Netflix or some streaming. You could watch movies at home, and you could order online, maybe, but you really couldn't go out at all, and the economy was very much shut down. So we know a lot of businesses that suffered because of that, but who won? Well, the answer is Microsoft, Netflix, Amazon, Google, which they call Alphabet, Facebook, which now is called Meta. They keep changing their names, but those were the stocks that did the best. Well, they no longer have that driver. As I said, with the exception of China, the pandemic's pretty much over. People are going out, they're going to retail, they're going to restaurants, et cetera. So they don't have that, impetus, if you will. And at the same time, they were very dependent on low interest rates. We had something in the United States in English called TINA, T-I-N-A, and that stands for there is no alternative. And that's TINA. And what it meant was that you had to buy the tech stocks because, U.S. Treasury bonds were offering nothing, bank deposits offered nothing. There were no good alternatives. Well, that's not true anymore. The 10-year Treasury note, which is a very safe investment, is yielding almost 3%. That's as much as the dividends on most stocks, for stocks that even pay dividends. So there is an alternative. So the combination of higher interest rates, the end of the pandemic, could lead to a very significant tailing off in tech stocks. Now, are there sectors that look interesting? Yes, I would say energy stocks, ExxonMobil, Shell, BP, Total, Chevron, and others. They've been beaten down because of all this, climate alarmism. There's not very good science behind. I mean, climate does change. I used to live on a beautiful body of water 10,000 years ago. It was a glacier, so it changed. But it took 10,000 years. But all this stuff about, the world's coming to an end in 10 years, it's all nonsense.
Before we continue, help us clicking that YouTube like button and subscribe now to our channel. This shows the algorithm that you valued this information. And it helps us spread that message. Sharing is caring. And now, let's continue.
We can't get away from oil and natural gas. We can't. Even you can bring in alternatives. I own the largest solar field in New England, non-commercial in New England, my part of the country. So I have a solar field. I know a lot about how they work, but you can't. It's intermittent. I know one thing: it doesn't work at night. It's not working today because we're having a snowstorm. So the point is, it's what's called intermittent power. Wind is intermittent, solar is intermittent. You cannot run a modern power grid because you need a base of power. You need a baseline of power at all times just to keep the grid functioning, and those things can't supply it. Plus, when you look at developing economies, the demand for energy is rising faster than the alternatives can scale. So sure, there's a role for wind and solar, that's fine, but demand is going up even more. So how do you fill the gap? The answer is oil, natural gas, and uranium if you want to build nuclear power plants. So we can't get away from it. They're going to do well. The stocks have been beaten down. So it's an interesting sector. And of course, I like gold, not all in, but maybe 10% of your investable assets. Real estate will do very well. Farmland will do very well. So even in adverse economic conditions, there are still sectors that will do fine and you can make a lot of money. Now, when you invest in gold mining stocks, in some ways, it's a leveraged bet on gold itself. And what I mean by that is if gold goes up, gold mining stocks can go up a lot more. But if gold goes down, gold mining stocks can go down a lot more. So they're more volatile than the gold itself. So you have to be careful. Don't use too much leverage because you can win big, but you can also lose big. So you have to be careful. And when you look at gold mining stocks, of course, you want to look at the underlying assets. Is the company in exploratory stage? Is it a junior miner or major miner? One of the interesting sectors are what they call junior miners. And the reason is, if they happen to be publicly traded, because they kind of know how much gold is there. They're past the exploratory stage. But often companies like that have difficulty raising capital to exploit the resource. So they get bought out by somebody bigger, Barrick Gold, Newmont Mining, IM Gold, some of the biggest gold companies in the world come along and buy up all these junior miners. So then you can make money not only on the gold, but on a buyout premium from the buyer. And that's attractive. As far as gold itself is concerned, it's going to do very well because the dollar, I'll use dollars, but you can think of this in any currency. The dollar price of gold is simply the inverse to the strength of the dollar. If there's a weak dollar, the dollar price of gold goes up. If there's a strong dollar, the dollar price of gold goes down. Well, in addition to gold stocks, you can invest in physical gold yourself directly. And I do recommend that, not too much. I'm certainly an advocate for having gold, but people think I would put, 50% or 100%, and that's not right. You should never put that much into any one asset class. But I think 10% is an appropriate